with new video after quiet week overall, I guess, in terms of the market moves. But what I'm going to go through today, I thought the Druckenmiller interview was interesting. It covered some points we've talked about here. So I thought this would be a good place to just kind of go through it. He said a lot in the interview. If you haven't watched it, it's 20 minutes. It's on Bloomberg. It's worth just going through. I'll go through many points that he covered. One of the ones in here that you'll see is just the election impact. He talked a lot about what's starting to happen and the fact that the market has built in many ways, Donald Trump winning. I'll go through where he's talking about in that. One thing he didn't mention, which I will bring up, is just the potential impact of Lina Khan no longer being the head of the FTC and how her time there has been important for the market, coinciding with some other things that have gone on. But I think that's an area that fits in with some of the themes I've talked about in terms of a broadening out of the market. And then finally, I'll just go through a quick update on China. So, in terms of specifically what he went through, I think, he basically said for at least the beginning part of this that the fact that the Fed cut 50 basis points when you've got stocks at all time highs, gold at all time highs, you've got GDP above trend, you've got credit tight. He was comparing this to the mistake they made with transitory and how back then, even though inflation was already showing that it was going to be much higher than what was expected and certainly much higher than the transitory side, they started that cycle of moves with 25 basis points, and the fact that they started this one of 25, he specifically covered it out, and he's talking about the risks of a melt up. He does get into, which I'll go through a little bit here, the inflation risks, which I see the exact same way. I think the most important thing is, since a lot of people watched last week and were asking questions about what's going on, stocks are in an uptrend, and the broadening out looks to me like it's starting to happen. I think stocks will be up again next year unless, and this is the big unless, it's not going to come from a recession. It's not going to come from earnings turning down. It would have to happen from inflation really accelerating, the Fed having to turn the other way and creating the uncertainty of potentially needing to start another tightening cycle. We don't have to worry about that for the near term because we still have inflation coming down, but it's something just to kind of go through in the back of your mind as to if we're not having a recession. We've gone through all these charts over the last 3 weeks of what it means for the Fed to be cutting into a non-recessionary period. It's very bullish for stocks. It's very, very bullish for risk assets. And so here you have, to Druckenmiller's point, you have the Fed cutting, and this is the last year of the S&P is up 40% year over year. Gold is up 40% year over year. Bitcoin is up 130 some odd. This was before the close on Friday. I think it's a little bit higher now, but you get the point that you've got gold, Bitcoin, the S&P at all time, or up significantly over the last year. You have credit spreads near all-time tights. Jim Bianco put this out on Twitter this week, and I think it's a great way to see it. He basically went back and looked at days following the first rate cut, and he goes back in the earliest time period on here is 1989, and you can see that rates have gone up the most for tenure yields of any time, which again is an indication that if rates are rising after the Fed surprised with 50, that the market is saying that they shouldn't have done it. Tips are saying the exact same thing. I've talked about this. I tweeted about this. Inflation expectations were headed down. We made the lows just before the Fed eased 50, and now we've gone back up. And actually, inflation expectations, believe it or not, are higher than where they started the year. There's just no other way to look at it other than to say that the Fed has done something which the market is saying is very stimulative. It comes at a time when deficits are already high. This is another Jim Bianco one. I thought it was important just because he overlaid, going back to 1970, the recessionary periods, and you can just see as a percentage of GDP where we are. This is normally when you've come out of recession, you're trying to get the economy going. The fiscal dominance is just dramatic at this point. The spending side, there's just really no chance that this is going to change. This is a very simple chart, but it shows this line here is the mandatory spending. So just think of this as entitlements. the parts where they really can't cut anything, that's now 60%. The blue line here is the discretionary. So you can see the discretionary in the 60s was way up here and it's been in decline. But now what you have is it's down to 30%. So think of it as that's the part of their budget where they could actually cut anything. And then you've got this growing part here, which is the interest expense. So when you combine the two of them, the mandatory spending, which is already up here, and you've got the situation with demographics kicking in, and you have the interest expense. This is why going forward, when you look at any of the projections, the deficit's not going to get better. The other part of this, which again, despite how many people are still saying the economy is weak, even though we've had now, I think it's 9 quarters when you include the GDP now estimate of 3.4% currently, you're talking about 9 quarters of being effectively over 3% on average. So people are still focused on things which just are not real. And this is real gross domestic product related to potential gross domestic product. We're just at very high levels. So you're having to forecast a dramatic shift here in the economy as the Fed is easing when it's already sitting here. Again, I mentioned that he brought up the election. That's where I want to go now, because I think the thing this week that became built into the markets was not just Trump winning as a higher probability, but also you've got a Republican sweep in the betting markets that's up to 41%. And the reason this is important, regardless of what you think is going to happen, I believe that Lina Khan being in here, being in as the FTC, has had a much bigger impact on the market than people realize. This comes from just conversations with people about how important it is for small private companies to be able to be monetized. If you listen to the All In podcast, they talk about this a lot. But I spent a lot of time listening to AI and just what's happening with smaller businesses, and you have a lot of people still concerned about the inability for investments to monetize. And I think this trickles down, just like in the housing market, the old plankton theory. If you're hurting the ability for M&A, if you're hurting one of the options that happens from monetization, it just depresses things. And I think this has probably been more of an impact than people realize. She took over, she was nominated, I believe, in it was somewhere between March or June of 21. And this is kind of a bipartisan complaint from business people. So this just gets into the point. There's an article in The Atlantic saying how Silicon Valley is doing this, that it's hurting the little guy. As I mentioned, her leadership came in 21, and she's talking about trying to do more. This one was interesting because in that same article in The Atlantic, I just highlighted this. This is, mentions Reid Hoffman, who's a big donor in the Democratic Party. Even he on this thing this is his, a major point of his, is waging war on American business and hope that Harris would replace her if she was elected. Barry Diller said the same thing. So you're at a point where when you look at the facts behind it, 2021 is right here. This is what's happening to M&A activity. You're back down to levels that you have to go back into the 90s. So with that happening, it has an impact. And I think that's one of the reasons why she takes over in here. Here's what's happened to small business sentiment. Now, again, most of this here, in my opinion, is related to the inflation stuff, which is still having an impact. I also think AI is having an impact. I also think the rate hikes are having an impact. So this is not all there, but you're looking for things in the market which could be a catalyst. And I'm looking at the fact that whether it's somewhere on the venture capital side, the private equity side, that you could see a change in there if you're getting more of an comfort that there can be M&A activity. PMIs have come down since 21. Again, not all because of Lina Khan, but I think it's a theme here that you're looking again for shifts. Consumer confidence has come down. Again, look at this, all from 2021. So between the rate hikes, between, let's say, the zero COVID policy having an impact, stocks started to go down. You just haven't had a bounce up. Well, now we have the reverse going on. China is absolutely stimulating. I'll finish with China today. There's no doubt that they are trying to put a floor under the market, a floor under housing. That's a big shift because things have been in a deceleration. You have the Fed cutting rates, no longer raising rates. You have inflation coming down. You've had commodities come down, but all of those things have not led to anything positive. So you're looking for more shifts, and I think another shift here is the Lina Khan situation. And you can see it in small versus large. So even though all those things I mentioned about inflation, about China, there's no doubt that what we've seen here is a dramatic shift in big versus large. So what I put up here was this is the mega cap, the Magnificent Seven chart here, the purple line, and then this here, the line here is ARC. So this is the Cathie Wood innovation side. So these were very correlated before. You've seen a disconnect here. The white line is small cap versus large cap, which has gone down, which fits in. And then one other one I included. This is Bitcoin on the green side, which is hung out here. The XAI here is the alt index. So think this is the altcoin index. So even though Bitcoin has gone higher, we have not seen any kind of breath in the altcoins. I think that has absolutely been impacted by Lina Khan. So I'm expecting a big shift here on that part. And if we do get any kind of movement, these charts are all just starting to break out. So again, 2021 peak here, Lina Khan is appointed. The breadth in the market, it takes all the way until very recently in 2024 for the breadth to get up. So this is not some uber bull market. This has been very concentrated, which means there's lots of room for other stocks to participate, even if it's from a value perspective, but especially if we get any kind of an increase, as Stan talked about, in terms of a melt up. Mid cap just recently broke up again, another one of these beautiful cup and handle type formations. IWM hasn't broke out yet, but that's another one. So you have small cap, which is sitting here. Definitely not some kind of extended market. Equal weight S&P. Again, this one has made new highs, but it's been grinding. It hasn't been moving in some fast manner. And one of the things that's happened over the last 3 months is that the S&P is now up 4% since July 10th. So you're dealing with a little bit over a quarter. You can see that tech and communication services, which is another name for tech along for this is where you're dealing with Amazon and Google and all of the Magnificent Seven. They're basically not moved in the last 3 months. So there's been a broadening out that's been happening. And that's one of the positive things I think that's gone on without people really noticing. It says the S&P has gone to new highs. It's been led by different leadership. Transports have not broken out yet. I think that's going to happen in this next move. Bitcoin still continues to consolidate here, but again, I mentioned this a few weeks ago. We made the lows here. Since then, went up here, came down, higher low, higher high, higher low, and now we've made another higher high. I do believe that you're going to get a breakout here at some point. It seems like the way these things have gone, that with Trump winning, it seems like Bitcoin will be breaking out. But again, I think regardless of who wins the election, this chart is telling you that stuff's going higher, mainly because liquidity is increasing around the globe. And I do still believe that Bitcoin is directly tied to the AI story. I wrote a Substack on that this week. I just think that that's a place that people have to be invested in if they're looking at AI. On another level, the NVIDIA, we made new highs. I don't think the market can possibly go down for any long period of time, as long as the AI trend continues to show that it has not peaked. Even though we've had a euphoric peak in terms of the AI names ex NVIDIA continues to just act like something which is going to go much higher. And if you get the chance, it's highly worth watching 2 interviews or 2 YouTubes. They're both you can both listen to them, obviously. This is from the BG2 podcast with Brad Gerstner and Bill Gurley, and you've got Jensen Huang on there talking. And I think it's important to listen to, just because he talks about AI agents. Again, I've brought this up, but you have to start listening and building this into your forecast for the next 2 years, because it's coming and it has huge profitability and profit margin side. So if we don't see inflation go higher and have some kind of fear that the Fed is going to have to raise rates, the story by the time we get into the end of next year is going to be about AI agents and the rise of them, which means a workforce that is going to be 24 hours a day, and it's just going to start bringing up productivity. It won't happen overnight. He gets into the timeline of this, but it is starting next year. In this interview with Mark Benioff, he goes through it as well. So I think you have to listen to Jensen as much as possible. Nvidia is the most important stock in the S&P 500, but in particular, when you're looking for what's driving this market, it's been about profit margins. So for anyone who wants to be negative on the market, you either need a recession or you need inflation to get out of control, or both. And there's nothing on the horizon yet that could be there. I do think inflation is bottoming, but if gas at the pump doesn't go higher, I don't see a big move higher in inflation because I don't see the wage growth that's coming through with AI agents being in there. So I think we're still in the early stages of a bull market here. I think stocks are going to continue to go higher. Whenever you have recession fears, I think you have to look at that point to wait for sentiment to come down. But we're not at one of those points now. We're actually at a point where it looks like things are about to break out in a more broad way. In terms of China, they released data this week, and I'm sure what's going to happen now is everyone will start doubting all the data because people seem to want to be bearish on China. China is absolutely 100% continuing to throw more money. There were more stimulus measures this week. It is not about are they doing enough to create some kind of massive growth. They don't want that. They're just trying to change animal spirits inside the country. And so what you want to look for is stuff like this. I've mentioned it before on here, but in my time in China, and I spent a lot of time in China from 2008 to 2016, about a month a year, retail sales were continually growing in that decade at about 10%. They fell to 2.1% year over year before the most recent reading, which came in at 3.2. That's where most of the drop off was. People are just not feeling confident, and it was because house prices were going down. It was because they didn't trust the government. There were all kinds of things. But now the government's going out there and saying they're going to make stocks go higher and they're going to stop the housing market from falling. This is what you want to look at. They already had a surprise on the positive side for the week. Just to finish off this video, the local markets finished up for the week. So, you had these two massive weeks. Then you had a correction. Everyone said they're failing. The local markets were up again. I'm going to continue to say you want to watch the Chinext. It had a big week, or up 4.5%. So it completely took out most of the fall, if not all the fall from last week. So you had a positive move on the Chinext, which is their innovation index. For the foreign world, the Hang Seng was down again slightly last week, but 2%, so you're getting less volatility. And the HS Tech market was down slightly as well. But I think China has put a floor in. The Fed's cutting rates, and I'm in line with Stan Druckenmiller on this one. I think the Fed is risking inflation coming back up, but we're not there yet. So for the time being, the inflation that will happen is in risk assets. I would focus on Bitcoin breaking out, and I would watch Nvidia as we're entering the earnings period. And if you get the chance, watch those videos. Thanks for joining. If you guys have any questions, don't hesitate to reach out. It makes it fun for me to respond. Thanks. Bye.